Hello and welcome to topic 3 of module 3 on the FX series. Now we're going to be looking at currency options. Currency options are basically a derivative instrument, so they derive their value from an underlying. We discussed the underlying, the currency futures, in the previous topic. So if you missed that, please go online and you can download the slides, or you can download the training manual for more information and also more worked examples. So what are currency options? You get two types of currency options. You get a call option, and basically the call option gives you, the buyer of the option, the right but not the obligation to buy. So if we take a step back and think about the futures contract, if you were buying dollars with an FEC or a futures contract, you were obliged to buy. Irrespective of where the market was at maturity, it was an obligation, a contractual obligation to buy. Now with options, you now have the option, you've got the choice, but you don't have the obligation, the contractual obligation to buy. And then the other type of option we have is a put option. And a put option basically gives you, the buyer of a put option, the right but not the obligation to sell. So with a futures contract, if you are selling, if you've got a contract to sell dollars, then you would be contractually obliged to sell at maturity, but it's not the case with an option. And we're going to look at a very simplified example to explain the concept further. So with the futures contracts, we spoke about a contract price. With the options, we talk about a strike price. So that's just some terminology in with options. So if we say, for example, you've got an option, a call option, with a strike of 11, which means that you've got the right but not the obligation to buy dollars at 11 rands per dollar. That's basically what it means. So if the market at maturity is at 13, everyone who's buying at spot would be buying at 13, and you would exercise your right to buy at 11. So because the market has moved in your favor, you then exercise your option to buy at a more favorable rate. However, if the market moves against you, whereas now spot is lower than what your strike price is, then you simply walk away. You are not obliged to buy your dollars at 11. Whereas with a futures contract, you'd be obliged to buy at 11 because you were contractually bound to buy. And that's how it works with an option. Another thing I wanted to mention about options, currency options that are traded via the exchange, is that the style of the option is what we call a European option style. So that basically means that the exercising of the option only happens at maturity, whereas the other style of options is American style. And with American style, you can exercise it any time, even prior to maturity. Now let's look at a case where you'd exercise a put option. So remember, a put option gives you the right but not the obligation to sell your dollars. Okay, that's when you buy the put option. So let's say you buy a put option with a strike or contract rate of 11, and the market moves to 13. So why would you want to sell your dollars at 11 when the rest of the market is selling at 13? So in this instance, you would just walk away and you would just trade at spot, meaning that you could now trade and sell your dollars at 13. Whereas with the market moving in your favor, so if the market had to move to 9, dollar rand moved to 9, you could then exercise your option to sell your dollars at 11 when the rest of the market has to sell at 9. So that's the beauty of an option. When the market is in your favor, you exercise your option, and when the market moves not in your favor, you can then transact at a favorable spot rate. And that is basically an overview of how exercising puts and calls works. But as I've mentioned before, if you download the training manual, there's more information and more worked examples, and you can also go through it at your own pace. So please do check it out online and do download.